price pushes higher. But it still moves under old resistance. The session forms below compressed memory. Before any 1-hour trade, the higher time frame must come first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those lines are not background. They are the field. When price moves near those areas, a 1-hour bounce can look strong and still stay trapped. A breakout can look clean and still fail at the next box. A long can work, but only when lower memory holds. A short can work, but only when recovery fails. That is why the session line matters. Now look at June 10th Asia session. June 10th Asia session forms below June 10th US session box. It forms compressed. It overlaps underneath that memory. The session forms at the boundary of lower recovery and upper pressure. That matters. A compressed session box does not give wide freedom. It gives a tight test. Distance becomes shorter. Reaction comes faster. Continuation can fail earlier. Price has less room to hide. After June 10th Asia forms, price moves higher. It breaks above June 10th US session upper boundary. Then it pushes toward June 8th US session lower boundary. The move looks strong, but it is still moving into old resistance. It is not a free trend yet. It is a recovery through stacked session memory. So the long must be built from the line, not from excitement. We use the same order every time. Stop line first, entry line second, target line third. Most traders begin with entry. They see a green candle. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the trade does not deserve action. So the long starts with risk. June 10th Asia long setup. Entry line. June 10th Asia session upper boundary. Stop loss line. June 5th US session lower boundary. Take profit line. June 9th US session upper boundary. Risk-reward ratio 1.58. The entry sits at June 10th Asia session upper boundary. Why there? Because price must prove that the compressed Asia box can push above its own upper side. If price stays below that upper boundary, the recovery is not ready. If price reaches the upper boundary, breaks through, and holds above it, buyers show control. The entry is not the first green candle. The entry is the hold above the active session line. Price reaches. It breaks. It holds. Then the long becomes active. The stop sits at June 5th US session lower boundary. That stop may look deep, but it protects the real base of the trade. The long depends on recovery from lower memory. If price loses June 5th US lower boundary, the market has returned too deeply into the old lower structure. The bounce no longer has clean control. So that line becomes the failure line. If price reaches it, the long is no longer the same trade. Leave. No hope, no argument, no waiting for one more candle. The target sits at June 9th US session upper boundary. Why there? Because price is pushing back into the upper memory created before. That upper boundary is where reaction can appear. It is where buyers must prove that the recovery can continue. So the target does not sit randomly above price. It sits at the next working session memory. Price reaches the June 10th Asia upper boundary. It holds. Distance opens upward. The target becomes June 9th US upper boundary. Risk-reward ratio is 1.58. That is just above the minimum filter. So execution must be clean. If the entry is late, the ratio weakens. If the stop is widened, the ratio weakens. If the target is moved higher before price earns distance, the trade becomes hope. This long is not a wide trend trade. It is a recovery trade from compressed lower memory into old upper memory. Now watch the behavior. Price pushes higher, but the move is not smooth. Pullbacks appear. Reaction comes back. The market still sits inside a crowded session field. That is why the trader cannot relax. If price moves toward the target and stalls, protect. If price keeps distance, let the trade work. If price loses the active line, reduce risk. The trade is valid because the line holds, not because the market feels bullish. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays. But compressed boxes can whip. A wick can touch the tight stop. Then price can still move toward the target. The idea was right. The position is gone. That pain must be accepted. A conservative trader gives the structure more room. The stop respects deeper memory. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, no trade becomes the conservative answer. Here, the ratio is 1.58. It is tradable, but not generous. So the entry must be close to the line. Now management. If price reaches the target, protect. Do not assume the next breakout. June 9th U.S. upper boundary can reject price. If price reaches it and stalls, take the result. If price breaks it and holds above it, then a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope, but the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last green candle. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not create edge. The edge comes from the line. The edge comes from compression holding. The edge comes from risk-reward staying alive. June 10th, Asia gives the first message. Price rises. But it rises through old memory. The long works only when the compressed upper boundary holds. Price reaches. It reacts. It holds. Then the trade begins. Price lifts again, but the box still refuses freedom. The session forms near the same middle memory. Before reading June 11th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. These levels still shape the 1-hour chart. The market has already bounced from lower memory. But a bounce does not erase the field. A recovery can move higher. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 11th U.S. session. June 11th U.S. session forms near the June 4th U.S. session midpoint. It compresses to about 30%. It overlaps there. That matters. For the recent week, Asia sessions and US sessions have been clustering in a specific area. Compression appears. Expansion appears. Overlap appears. Again and again. The daily chart shows that crowding clearly. The 1-hour chart feels noisy because the larger structure is packed with memory. Price is not moving through empty space. It is moving through layered boxes. That creates fast reactions. It creates short distance. It creates early failure. So the session line becomes more important. June 11th US session forms inside this dense area. Then price moves lower. It tests June 10th US session upper boundary. It also tests June 5th US session upper boundary area. Then price moves higher again. It tries to test June 8th US session upper area. The move is not random. It is a rotation from lower held memory toward upper memory. Now the trade must be built from risk. Stop line first. Entry line second. Target line third. June 11th US long setup. Entry line. June 10th US session upper boundary. Stop loss line. June 10th US session midpoint. Take profit line. June 8th US session midpoint. Risk-reward ratio 2.29. The entry sits at June 10th US session upper boundary. Why there? Because price tested that line from above and had to hold it. If price loses June 10th US upper boundary, the recovery falls back into the prior session body. The long becomes weak. But if price reaches that upper boundary, reacts and holds, buyers defend the old breakout line. That creates the long. The entry is not the upward candle. The entry is the defended line. Price falls into the line. It cannot break lower. Reaction turns up. Distance starts to open upward. Then the long becomes active. The stop sits at June 10th US session midpoint. That stop protects the trade without giving too much room. The long depends on June 10th US upper boundary holding. If price loses the midpoint of that same session box, the defense has failed too deeply. The market has returned into the center of the prior structure. The long no longer has clean control. So the stop belongs at the midpoint, not because it is close, because the idea changes there. If price reaches that midpoint, leave. No waiting. No argument. No second guess. The target sits at June 8th US session midpoint. Why there? Because June 8th US memory is still above. The market is moving from defended June 10th memory toward the next older midpoint. The June 8th US midpoint is not the highest line, but it is the first meaningful target where price can react. It gives enough distance. It keeps the trade realistic. Risk-reward ratio is 2.29. That is stronger than the first long. Now the trade has room. The entry is clear. The stop is defined. The target pays. That is the difference. The same bounce can be weak if the ratio fails. The same bounce can be valid if the lines align. Here, the lines align. Now watch the behavior. Price reaches the lower test. It holds. Then the reaction moves higher. But the move still stays inside crowded session memory. The trader must not turn this into a prediction. It is a trade from one defended line to the next working target. If price reaches June 8th US midpoint and stalls, protect. If price breaks through and holds, a new structure can form later. But until the hold appears, the first job is to take the target seriously. The target is where profit must be protected, not where hope begins. Now think about aggressive and conservative execution. An aggressive trader may tighten the stop above June 10th US midpoint. The risk becomes smaller. Position size can become larger. The ratio improves. Sometimes the market never touches that tight stop. The trade pays fast. But compressed ranges can shake hard. A small dip can touch the stop. Then price can still rise toward the target. The trader reads the direction correctly. The position disappears. A conservative trader respects the midpoint stop. The position size becomes smaller. The trade survives more noise. But if the stop becomes even wider, the target must also change. A wider stop with the same target can damage the ratio. That is why the stop, entry, and target must always be read together. Never move one line without checking the others. Now management. When price moves toward June 8th US midpoint, watch the distance. If distance expands cleanly, hold. If reaction speeds up, protect. If price stalls under the target, do not force continuation. The market is still inside a dense weekly field. The 20 moving average and 120 moving average areas can also slow movement when price rotates inside the box. Double Bollinger pressure can widen and contract around the same zone. But the trade still starts from the session line. Indicators help you see pressure. The box gives the execution. If price reaches target and still holds, a trail can be studied. But only after profit is earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. The stop must not sit too tight. Normal reaction can remove the position. The stop must not sit too loose. Then profit is not protected. So the stop follows structure. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not save a bad entry. The structure comes first. June 11th US gives the second message. Recent sessions are clustered. The range is compressed. The line must hold first. Then the trade opens. Entry. June 10th US upper boundary. Stop. June 10th US midpoint. Target. June 8th US midpoint. Risk-reward ratio. 2.29. Price reaches. It reacts. It holds. Then the long earns execution. Price tests the top, but it cannot stay above. The session forms above compressed support. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a bounce can look ready and still fail at the next line. A short can look risky and still pay after upper memory fails. A long can look obvious and still lose control when the box cannot hold. That is why we focus on the session. Now look at June 11th Asia session. June 11th Asia session forms above June 8th US session lower boundary. It compresses by about 50%. It overlaps there. The session forms inside a crowded one-week area. That matters. Recent sessions are not spread cleanly across the chart. They are packed. US boxes and Asia boxes keep overlapping. Compression, expansion, and overlap keep appearing in the same region. That creates short distance. It creates faster reaction. It creates earlier failure. price can touch a line and turn quickly. So the trade must come from the boundary, not from the middle. June 11th Asia session continues inside its own basis box. It tests the upper side. Then it falls. It tests June 11th US session midpoint. That movement gives the short. Upper test. Failure. Return to the midpoint. Now build the trade in the correct order. Stop line first. Entry line second. Target line third. June 11th Asia short setup. Entry line. June 11th Asia session upper boundary. Stop loss line. June 8th US session upper boundary. Take profit line. June 11th US session midpoint. Risk-reward ratio 1.96. The entry sits at June 11th Asia session upper boundary. Why there? Because price must prove whether the upper side can hold. If price reaches June 11th Asia upper boundary and stays above it, the short has no reason. If price reaches that upper boundary and cannot stay, buyers fail. That failure gives the short. The short is not a blind sell. It is the response to failed holding. Price reaches. It reacts. It cannot stay. Distance does not open upward. Continuation fails earlier. Reaction comes back faster. Then the short becomes active. The stop sits at June 8th US session upper boundary. Why there? Because June 8th US upper memory is the higher failure line. If price recovers above that area and holds, the short loses control. The market is not only reclaiming the Asia upper side, it is attacking older US memory. The short idea is damaged. So the stop belongs there. Not too close to the candle. Not placed from fear. Placed where the trade loses its reason. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at June 11th US session midpoint. Why there? Because after the Asia upper boundary fails, price returns into the active US memory. The midpoint becomes the first clean destination. It is not the lowest possible target. It is the target where reaction can appear. That makes the setup practical. Risk-reward ratio is 1.96. It pays enough, but it still needs a clean entry. If the trader enters late after price already moves down, the ratio weakens. If the stop is widened above June 8th US upper boundary, the ratio weakens. If the target is pushed lower before price earns distance, the trade becomes hope. The short must be taken near the upper failure, not after the easy move is gone. Now watch the behavior. Price tests the upper side. It cannot hold. The move stalls. Pullbacks deepen. Reaction speeds up. Then price rotates lower. The target is June 11th US midpoint. If price reaches that midpoint and stalls, protect. Do not assume a full breakdown. The market is still inside clustered session memory. A midpoint can stop the move. A lower boundary can react. A prior target can become the next entry. That is why the trader must stay flexible. Do not marry the short. Do not marry the long. The line decides. Now trader type matters. An aggressive trader may tighten the stop below June 8th US upper boundary. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never reaches the tight stop. The short pays fast, but a compressed box can whip. A wick can touch the tight stop. Then price can still fall. The idea was right. The position is gone. A conservative trader gives the stop more structural room. The position size becomes smaller. The trade survives more noise. But if the stop becomes too wide, the target must also move lower. A wide stop with a close target destroys risk-reward. So the trader must check the three lines together. Stop, entry, target. Every change affects the trade. Now management. If price reaches June 11th U.S. midpoint, protect. If price breaks below it and holds, a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot sit too tight. Normal reaction can touch it. The stop cannot sit too far. Profit can disappear. So the stop follows structure. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not create the edge. The edge comes from upper failure. The edge comes from a stop that protects the real idea. The edge comes from a target that pays. June 11th Asia gives the third message. The market tests the top. It cannot stay. It returns to the midpoint. Entry. June 11th Asia upper boundary. Stop. June 8th U.S. upper boundary. Target. June 11th U.S. midpoint. Risk-reward ratio. 1.96. Price reaches. It fails. It returns. Then the short earns execution. Price moves inside the final cluster. But neither side pays enough. The session forms inside compressed weekly pressure. Before reading June 12th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has already spent the week inside crowded memory. Asia boxes and US boxes keep pressing into the same region. Compression appears. Expansion appears. Overlap appears. Then compression appears again. That is not clean trend behavior. That is a field of repeated tests. The closer the lines become, the harder execution becomes. Now look at June 12th U.S. session. June 12th U.S. session forms near June 11th U.S. session, upper boundary and midpoint. It compresses by about 50%. It overlaps there. The session forms inside the same crowded area. That matters. Price then moves higher. It tests June 8th U.S. session upper boundary. Then it moves lower. It tests June 12th U.S. session upper boundary. The move creates temptation. Long traders see the upper test. Short traders see the rejection. Both sides want action. But the trade still needs clean lines. Stop line. Entry line. Target line. And the risk-reward must pay. Now list the working lines. Weekly 0.33. June 8th U.S. session upper boundary. June 8th U.S. session midpoint. June 12th U.S. session upper boundary. June 12th U.S. session lower boundary. June 11th U.S. session lower boundary. June 10th U.S. session upper boundary. June 5th U.S. session upper boundary. Several of these lines are close. That is the problem. When lines get too close, the market can move but still not give a clean trade. Price can rise. Price can fall. Reaction can look sharp. But the stop and target do not create enough distance. That is where many traders force a trade. They see movement. They ignore the ratio. They enter because the candle looks clear. Then the stop is too wide, or the target is too close, or the entry comes too late. The account pays for bad structure. Now check the long idea. A long could try to use June 12th U.S. lower boundary or nearby support as entry. The stop could sit below the next lower memory. The target could be June 8th U.S. upper area or weekly 0.33. But the distance is not clean. If the stop is placed safely, the target does not pay enough. If the stop is tightened to improve the ratio, normal reaction can touch it. If entry is late, the ratio breaks immediately. So the long does not give clean execution. Now check the short idea. A short could try to use June 12th U.S. upper boundary or June 8th U.S. upper area as entry. The stop could sit near weekly 0.33 or above the upper cluster. The target could be June 12th U.S. lower boundary, June 11th U.S. lower boundary, or the nearby June 10th and June 5th upper memory. But the same problem appears. The lines are packed. The target is close. The stop can become too deep. The ratio struggles to reach 1.5 cleanly. If the trader tightens the stop, the trade becomes fragile. If the trader widens the stop, the trade loses reward. So the short also stays weak. That is why the best decision can be no trade. Not because the chart is quiet. The chart is active. Not because there are no lines. There are many lines. Too many lines are too close. That creates noise. The final session of the week adds more risk. Weekend pressure can change behavior. Liquidity can thin. Traders can close positions. The market can move fast without giving clean follow-through. So the final filter becomes strict. If long and short combinations do not produce clean 1.5 risk-reward, skip. No trade protects the account. No trade saves capital for the next clean setup. No trade keeps the trader from paying for a crowded range. Now compare this with the previous sessions. June 10th Asia gave a long with risk-reward 1.58. It was not huge, but the lines were clear. June 11th US gave a long with risk-reward 2.29. The defended line and target gave better structure. June 11th Asia gave a short with risk-reward 1.96. Upper failure created space to the midpoint. June 12th US gives movement, but the combinations do not pay cleanly. That contrast matters. A trader must know the difference between movement and execution. Movement is what price does. Execution is where the account can survive. The market can move without giving a trade. That is not a missed opportunity. That is a saved mistake. Now trader type matters again. An aggressive trader may try to force a tight stop. The stop becomes smaller. The ratio may look better. But inside a compressed cluster, tight stops get hit often. A small wick can remove the position. Then, price can move in the planned direction. The trader was early. The position is gone. A conservative trader may use a wider stop. That can survive noise. But then the target must move farther. If the farther target is not realistic, the trade should be skipped. A wider stop with a close target is not conservative. It is bad math. So both styles reach the same answer. No clean trade. Now, management for no trade. Do not sit and wait for a candle to convince you. The filter already answered. If stop, entry, and target do not align, the account waits. If the market breaks clearly later, wait for the next session memory. If price reclaims and holds above the cluster, a future long can form. If price fails and returns below the cluster, a future short can form. But during the final crowded session, the best action can be no action. That is still execution. The week ends with a lesson. The same method that takes trades must also reject trades. It took the long when the line held. It took the short when the upper side failed. It skipped when the lines did not pay. That is how the account survives. Price reaches. It reacts. It holds or fails. But if the risk does not deserve the reward, the trader does nothing. June 12th US gives the final message. Compression is not always opportunity. Overlap is not always entry. A famous line is not enough. A strong candle is not enough. Only clean structure earns the trade. Stop. Entry. Target. Risk-reward. If those do not align, the week ends with no trade.